In this video, I'll share 9 bad money habits that hold you tight and give you tips to make your finances right, so you can stop stressing and sleep at night. Hey everyone, welcome back to the channel. If you're new here, I'm Avi, a chartered accountant based in Melbourne, Australia. Over the past 5 years, I have dedicated myself to the world of finance, earning a degree in finance, completing my CA qualification and building a career in accounting. Throughout this journey, one of the most important lessons I have learned is how to effectively manage my own finances by identifying and breaking down my own bad money habits. So in this video, I'm going to share with you 9 of the most common bad money habits that can stop you from becoming financially free and some practical tips on how to live stress-free. Number 1. Paying yourself last. I first came across this concept in the book Rich Dad Poor Dad by Robert Kiyosaki, and it's one of the fundamental principles in achieving financial freedom. Robert explains that there are 2 common ways people manage their money. The first is what he refers to as the poor people habit, and that is paying yourself last. In this approach, as soon as you receive your paycheck, you immediately pay your bills, rent, utilities, subscriptions, and any other expenses, and then save whatever's left over if there's any money left to save. The second habit he describes is what the wealthy tend to do. They pay themselves first. This is the strategy you want to adopt. As soon as you get paid, set aside at least 10% of your income and put it into your savings or investment account. Treat this like any other bill, something that must be paid first. This simple habit ensures that you prioritize saving rather than spending everything and trying to save what's left. Now, I know a lot of you might be thinking, I live paycheck to paycheck, there's no way I can do this. But the surprising thing is, once you start paying yourself first, your mindset begins to shift. You will find ways to adjust your spending to make that 10% work, and it won't feel as challenging as you think right now. Most people don't realize how much they are spending on recurring bills, impulsive purchases, or lifestyle habits. They end up saving only what's left, if anything. But this backward approach doesn't set you up for financial success. The key is to pay yourself first to ensure that you're building your wealth before you spend on anything else. The second bad money habit is getting comfortable with debt. It seems like taking on debt has become the norm today. Many people use credit cards to buy even the smallest things like clothes, gifts, electronics, and so on. Personally, I have a simple rule: if I can't afford to pay for something in full with cash, I don't buy it using debt. It's important to remember that credit card companies actually profit when people mismanage their finances. They make money when you carry a balance and pay high interest rates. The average credit card interest rate is around 22%, which quickly cancels out any rewards or benefit these cards might offer. If you are not able to pay off your balance in full every month, the interest charges will outweigh any perks you receive from using these cards. The third bad money habit is not having an emergency fund. This ties closely to my first point about paying yourself first. Essentially, it's about building a safety net by saving enough to cover your expenses for a minimum of 3 to 6 months. This is super important as it will also give you peace of mind and financial security. When you know there's a reserve set aside for emergencies, it frees up your mental energy to focus on more important things. So how you can build this 6-month fund? It's essentially by paying yourself first. Start by consistently setting aside at least 10% of your income. Once you've established this buffer, you can redirect your savings towards building an investment fund and exploring other growth opportunities. The fourth bad habit is not having a clear understanding of your income and expenses. Before you can plan where you want to go financially, you need to know where you're starting. There's something called lifestyle inflation, and that is spending increases as your income increases. The more money you make, the more you spend, and it's a cycle. Make more money, buy a bigger house, buy a nice car, spend more, make more, and it's crazy how normal this is, but it's a recipe for financial disaster. If you want to take control of your finances, you need to map out exactly where your money is going. That's why a budget tracker is super important. Your budget should detail your income, the 10% you're setting aside to pay yourself first, your expenses, bills, rent, mortgage, discretionary expenses, and debt repayments. Make it a habit to review and update your tracker at least once every 3 months. People who know where they are financially, they know their assets, they know their liabilities, they have a clear goal on where they want to go financially, are much more likely to build wealth compared to people who just fantasize about money but have no idea on how to earn it or how to manage it. The fifth bad money habit is having expensive hobbies. A lot of people love to shop, it's often called retail therapy. But here's the thing, marketing, social media, and big companies are constantly trying to convince us to spend money instead of saving or investing it. They make us feel like we need the latest gadgets, clothes, or trends to be happy. While hobbies and treating yourself isn't bad, but expensive habits can quickly drain your wallet. It's important to step back and ask yourself, is this really adding value to my life, or is it just a way to spend money without thinking? Next bad habit is focusing only on saving. If you want to improve your financial situation, you have two main options. Save more from what you already earn, or make more money by creating additional income streams. And the best approach is a combination of both. You can't build wealth if you're earning more but spending it all. At the same time, just focusing on savings won't work either, because there's a limit to how much you can save. To truly grow your wealth, you need to look at both sides. Think about how you can save a bigger percentage of your income, but also how you can increase your earning potential. The saving side has a limit, but the earning side doesn't. There's unlimited potential in making more money, whether it's investing in the stock market, asking for a raise, or starting a side hustle. If you want to break the bad habit of relying only on savings, start thinking about how to grow your income too. Number 7 is paying too much in taxes. Taxes are likely to be the biggest expense in your life. While everyone has to pay them, many people don't take time to think about how they can legally reduce their tax bill. The key word here is legally. Wealthy people often understand how to use legal tax structures to reduce their tax bill. They hire tax advisors to help minimize their tax bills. If you want to build wealth, one of the smartest moves you can make is to learn the tax rules and use them to work in your favor. For example, you could invest through an ISA or Roth IRA accounts that protect your dividends and profits from taxes. If you are a solopreneur, operating as a business instead of an individual might give you certain tax benefits. These strategies are completely legal, and understanding them can save you money that you can redirect toward things that matters to you. Even if you're someone who doesn't mind paying more taxes, it's still worth knowing the rules. Next bad habit is waiting too long to invest. Once you have built your savings and that emergency fund we talked about earlier, it's time to start investing. Investing allows your money to work for you and help you build your wealth over time. It's also important to diversify your investments so you are prepared for life's up and down. The biggest mistake is leaving extra money sitting in your bank account. With inflation, the value of your money decreases every year. So keeping too much cash in bank could actually erode your savings in the long run. Personally, I have a mix of safe investments and some riskier ones that I'm okay with losing if things don't go as planned. The key is to start exploring investment strategies once you're saved enough. Don't let your fear or excuses hold you back, like thinking you don't have enough money, time, or knowledge. The truth is, the longer you wait to invest, the harder it will be to reach the same level of financial freedom as someone who started earlier. So don't delay, take the first step and start growing your money today. If you're ready to start your investing journey today, I've got a simple guide for beginners on the stock market. Just click here to watch the video and get started. And the last one is finding the right person or tools that resonate with your financial style. Whether you're an employee or entrepreneur, someone who avoids risk or thrives on it, there's always a method or mentor that aligns with your approach to money. The key is to find the right tools, resources, or people who match your investing style and help you navigate your financial journey in a way that feels right for you. Thank you so much for watching. If you like to watch more videos on personal finance, let me know in the comments below. I'll see you in the next one. Until then, thank you.